If your mortgage rate has a 5 as the first number in it right now, you're probably having the same thought as a lot of Canadians. Am I stuck with this? Am I stuck paying this amount? Is there anything I can do? And that's because you're looking at your payments, you're looking at the interest, and you feel like you're doing all the work, but the balance is barely moving. Here's what most Canadians don't realize. There's a way to not only lower your rate without resetting your mortgage clock or paying a bunch of fees, but there's a way to actually use that rate drop to pay your mortgage down significantly faster without changing your monthly budget at all. This isn't a gimmick, it's not a loophole, it's just understanding how mortgage rules actually work here in Canada. Most homeowners fall into one of two paths. They do nothing because penalty fees are scary and they wait for renewal. Or they refinance and then they stretch their mortgage back out because the lower payment feels like relief. Sometimes that refinance is the right move, but a lot of the time, people reset the clock without realizing what it actually costs them in the long run. And that's where this strategy comes into play. In my world, I see mortgages every single day. And most homeowners think there's only two options, but there is a third option. One that sits on the boring part of the paperwork that nobody generally reads unless it's pointed out to them. I'm a mortgage broker here in Canada, and my job is basically to help people understand the rules of the game when it comes to getting or maintaining a mortgage so they can make choices that fit their goals. One of my biggest goals is to show customers actually how to pay their mortgage off faster than what their actual amortization says. Statistically, most of our clients are paying their houses off within 15 to 17 years, instead of 25 to 30, just by following simple guidelines and rules and ideas like the one I'm sharing in this video. Now, this video is educational, not personal financial advice, but I am going to show you the concept with real numbers so you can understand how it works. But if you wanted it broken down for your situation, there's a link in the description below. If you click it, it goes into my calendar. You can book a call with me or my team, and we can run these exact numbers and scenarios for you and your unique situation. Now, before we talk strategy, we need to clear up the biggest confusion that keeps people stuck. Switching and refinancing are not the same thing. A mortgage switch is like changing phone providers and keeping your existing number. You move your mortgage to a new lender without changing the balance and without resetting the amortization. If you have 20 years left, you keep 20 years. Now, a refinance is a brand new loan. That's where you can take out equity, consolidate debt, or extend your amortization back to 25 or 30 years to lower your payments. Now, refinancing can make sense in some situations, but if your goal is to pay your mortgage down as fast as possible, a refinance often does the opposite. It stretches out your timelines and can lead to costs such as legal fees and appraisals. So, if you're someone who can handle your current payments, the power move is usually switch cleanly and then redirect the savings. Here's the strategy in one sentence. If you can lower your rate but keep your payment the same, you force more of your money onto the principal. And that's what shortens the mortgage. Not willpower, not suffering, not noodles for dinner. It's math. And math doesn't lie. Step one is to, of course, get the lower interest rate. So that's the switch. You shop the mortgage. If the savings outweigh the costs of making the change, including any penalties or additional costs, you switch the mortgage over. Now, this is important. This is still a switch, not a refinance. Same balance, same remaining amortization. You can capitalize around $3,000 of costs into the new mortgage. Anything over and above that is generally going to have to come out of your pocket unless we work with a cash back option through select lenders. But at the end of the day, things are remaining very similar to what you had before. You're just getting a lower interest rate and a new term. Step two is to keep your payment the same or match your existing payment. When your rate drops, the lender is going to calculate a new payment for you. And most people will happily accept it because it's lower and it frees up your cash flow. It's more money in your pocket. But if you simply keep paying what you were paying before, the extra portion doesn't just disappear. It goes directly onto the principal of your mortgage. You're not increasing your lifestyle cost. You're just changing where money goes and making it move more effectively. Now, let's make this real because math and numbers don't lie. Say you have a $500,000 mortgage with 20 years left. So in scenario A, you're going to stay put. You're paying around 5.5% and your payments are about $3,137 a month. Now, in scenario B, you switch to a lower rate and match the payment. So you keep your payment the exact same as it was before, even though it could essentially go down. You find a lender with a rate of, let's say, 4.5%. Same mortgage balance, same 20-year remaining amortization. but at the lower rate. The minimum payment would drop down to about $2,876 a month. If you keep paying that original $3,137, that's roughly $261 a month going directly onto the principal. And here's what that does. It cuts your payoff timeline from 20 years down to roughly 17 years. And you save roughly $40,000 or more in interest over the life of the remaining mortgage. Same budget, less interest, and years shaved off. This is what people mean when they say, I want my mortgage to start feeling like it's actually going down. And this is a strategy that we've used with hundreds of customers to help them achieve these sort of outcomes. Now, here's the multiplier that makes this even more effective. And that's accelerated biweekly payments. I'm not talking about the standard biweekly payments where it's 12 months of payments broken up over a 26 pay period program. It's essentially 13 monthly payments broken up over that same 26 pay period program. So it's essentially like having an extra month of payments going directly towards the principal every single year. So if you combine a lower rate, matching your payments, and the accelerated schedule, you're attacking the principal faster and from two different directions. Using the same example as above, that can shorten your timeline to roughly 15 years and increase your total interest savings by even more than previously mentioned, even more than $40,000. Again, same budget, just a smarter structure. Now, I want to be clear. This strategy is powerful, but it's not for everyone. This is best for someone who can handle their current payments, wants to pay their mortgage off faster, wants to reduce lifetime interest, and doesn't need to pull equity or extend their amortization. If you're in a tight cash flow situation and you need breathing room, refinancing and lowering your payments may be the right decision, at least temporarily. This isn't a one strategy fits all sort of scenario. This is a know your goal and then choose the right tool to achieve it sort of moment. If you've been sitting staring at your mortgage statement thinking there has got to be a better way to deal with this than just simply waiting, this is one of the cleanest paths forward. You don't need to predict rates. You don't need to panic. You just need a plan that fits your budget, your stress tolerance, and your goals. Now, if you want, I can help you run the numbers for your specific mortgage. Not to sell you on anything, just so you can see if a switch and match strategy even makes sense after penalties and costs. And if you want more videos like this, practical, Canadian, no hype, subscribe to the channel and hit that like button, or maybe share this with someone who you think could benefit from watching this video. My name's Myles, the owner of the Nowik Mortgage team. Thanks so much for watching. We'll catch you on the next one.